So far, we've seen how important a fund house's reputation is and how to judge its performance track record. In this lesson, we'll be seeing how studying a fund's risk, ratings, and manager can help you pick the right one. Now, a simple question to ask yourself before investing in a fund is, how risky is the fund? It's clear to all of us by now that investing in equity mutual funds does involve an element of risk. So you really should know exactly how risky a fund is before you go ahead and invest. One of the ways to gauge this is with the help of a Morningstar risk rating, which gives you a fair idea of the risk involved in a particular fund. If you spot below average under the risk rating column, that means a fund has lower levels of risk. And above average or high would imply that the fund has comparatively higher levels of risk. At the end of the day, you should be able to sleep well after you invest. So you need to select a fund with a risk level that you are comfortable with. Apart from the rating, you should look at these two measures of risk. These are standard deviation and Sharpe ratio. Standard deviation is nothing but the measure of volatility in a fund. Higher the standard deviation, higher the risk. And as we've been saying all along, in the case of standard deviation as well, you should be checking the 1-year, 3-year, and 5-year values, comparing them to the values of the benchmark indices and peer funds. Remember, you also need to weigh the risks involved against the returns you're expecting. An ideal fund is the one that gives you higher returns than other funds do, but for the same amount of risk. The next parameter that experts use is what we call the Sharpe ratio, which gives you the return generated per unit of risk. In other words, Sharpe ratio measures the risk-adjusted returns that you can get. When analyzing the risk involved in any fund, you must also look at the fund's portfolio and ask yourself how diversified it actually is. Think about the number of sectors and stocks the portfolio holds. And ask yourself, is the portfolio diversified enough? And has it always been this diversified? So let's say you've asked all the right questions, you've thoroughly examined the portfolio, and you've even figured out the risk involved. What's next on your agenda? Well, if you're the type of person that won't even watch a movie until seeing how it's being rated and reviewed, then you really should be looking at your fund's star rating before you invest. Ratings are given by various agencies and companies like Morningstar and Value Research, among others. These ratings give you a general idea about a fund's performance. Morningstar rates funds on a scale of 1 to 5 stars. We can see here in this table how a variety of different funds have been rated. While it may sound logical to pick a fund with a 4 or 5-star rating, you need to be aware that ratings based on past history can't predict future performance. Nevertheless, be wary of funds with lower ratings. Treat ratings as a starting point and don't pick a fund solely based on their ratings. Now, just as important as how a fund performs is looking into who's actually running the show. Evaluating a fund manager's past performance is also a must, starting by looking at the last 3 years to 5 years of his or her record with respect to that fund. And don't forget to look at their track record with any other fund that they may have managed once. Like with most things in life, when it comes to fund managers, the more experience, the better. Make sure you pick someone with clearly stated criteria for buying and selling stocks. Someone who knows how to protect investors as much as possible when markets are bad. And with that, we've reached the end of this lesson in which we learned how to judge a fund by its risk, ratings, and manager. In our next lesson, we'll learn how to judge a fund by adding up all the costs you might incur by investing in it. Come, let's go crunch some numbers.